Welcome to Fitz Factor. I'm Scott McGregor at Scott Trades on Twitter, and I work with Dan Fitzpatrick to help mentor traders from all over the world at stockmarketmentor.com. Today on Fitz Factor, Dan and I discuss the current market conditions coming off of what happened in Russia over the weekend. We also talk about time frames and entries and give you some action steps that if you take will make you a more profitable and consistent trader. So let's get into it.
Okay, everybody. Welcome. So Scott, talk to me. Scott and I were actually just talking before about really kind of what's going on in the market. And frankly, I don't really feel like there's a whole lot going on today, these days. I'm just not seeing that. So I think that the most important thing is just to kind of not try to make trades happen, but just wait for them to happen. Mm-hmm. What do you think, Scott?
100%. We did get quite elevated above the moving averages recently over the last little bit here. And now we're just kind of coming back down to earth. And this to me so far, it looks like pretty healthy consolidation right here, Dan. Coming back to that 430 level, which was pretty key. We got just above 440 on SPY. And so now we're coming back and you can see how elevated things were just above that 21-day EMA or 20-day EMA. Mm-hmm. You talk about the Bollinger Bands a lot. When things get elevated outside the Bollinger Bands and start to poke outside the Bollinger Bands, like we saw a few weeks ago, that's when the trend is really getting a little bit, as you say, frothy. And so now, to me, this just seems like a bit of a rest within the confines of an uptrend. I do believe that we are in an uptrend. I do believe this has the potential to turn into, a real bull market. And that's despite all of the negative news that's out there. Over the weekend, we saw some pretty intense geopolitical stuff happening in Russia. And what did our markets do? Well, not much. That to me says that, maybe we are finally stepping away from headline risk in terms of geopolitics. Doesn't mean that something can't happen that changes that narrative. But for now, it does seem like money wants to be in the market. Money wants to come into the market. And now it's just about being patient and looking for those clean entries.
Yeah, I agree with you. On all the points that you were making. And I was thinking it's, today's always different than yesterday because it's today. Today's always different than last week. It feels different than a month ago, stuff like that. And it's all because something is happening now. As you move forward in your trading life, life in general, but as you move forward in your trading life, all the things that have happened in the past kind of get sorted through and organized such that hopefully you're learning the lessons that are important to learn, but you don't have the emotional attachment to it. And when I talk about an emotional attachment, I'm not necessarily talking about these big, huge swings of emotions. I'm just talking about, are you impatient? Did you impatiently buy last time or sell, or, what was your behavior like? And everything just kind of seems to smooth out from the past as we move forward. And I'm probably not being very articulate in the way that I explain it. But, this is the thing. What we're seeing right now is this pullback. Okay, well, look, this is different than this one. It's different than this one, et cetera, et cetera. I could go all the way back to illustrate my point. But the thing is, it's just like you're sitting here today, and what are your emotions? What are they telling you? Should I buy? Should I sell? It's just based on what you're seeing right now. And my wife, Jennifer, and I were talking about some things the other day with respect to what I would call filling in the blanks. And that is how important it is to communicate with each other and with yourself actually too. But what we were talking about was just how important it is to communicate with each other in a very complete way. And here's why. Because I bring the sum of my experiences, the things that are locked into my brain and my soul into this moment right now. So do you. So does, my wife. And so we all have our own different lenses that we look through to see reality, to see what's happening. If we're looking at charts, or if we're looking at someone's behavior, if we're looking at, somebody's looking at us and we're not exactly sure, why they're looking at us, or is that person staring at me or smirking at me or smiling at me or frowning at me? Does she like me? Does he, whatever the case may be. We look at things only through our own lens. And so if we have incomplete information, we're going to fill in the blanks. There is no void that will not be filled by something when it comes to what you're thinking about. And so when you commute, what you want to be doing, and I'm not giving relationship advice here. Trust me, you don't want it from me. But if you don't fill in the void that somebody else has with respect to what they're, thinking about you, or you're leaving something unsaid that should be said, that person is going to fill in the blank based on looking through their lens. And again, I still got a little snot in my head I'm trying to recover from this cold. So I'm not really articulating things as well as I would like. But to track it back to trading, you see what you see because you're looking through your lens. Somebody sitting next to you might be in an entirely different situation, and they're seeing the same thing that you're seeing in a dramatically different way. You're sitting here going like, okay, what do we got going here? It's Monday. I got to trade. I didn't do well last week, or, gosh, I like to day trade and shit, last week I wasn't trading much during the day. So today's a new day. And then others are more patient and circumspect and saying, well, I'm just looking at the chart here, looking at this area right here. And I don't really think I can expect that. So maybe I'll just kind of sit around and not do very much at all. And then somebody else isn't even looking at that. They're looking at this. They're looking at the weekly chart. They're looking at the monthly chart going like, hey, man, this looks pretty good. It all depends on not just what you're looking at, but what lens you're looking through to see it. And, for us now, the most important thing to do is let the market do its thing. Don't try to superimpose your desires, your needs, your need for action. Don't try to make the market do something to please you, because it's not going to do that. You have to be, you just kind of have to ebb and flow, swing with the market. If you're always walking through your trading life with magical thinking attached to your trading, you're going to have a short time span. And what do I mean by that? What I mean by that, by magical thinking, is, and we all kind of start this way, I think, or maybe it was just me. You have this magical thinking where you're looking at the market and you're imagining it doing what you want it to do. And then that imagination turns into expectation. And then you're expecting the market to do what you want it to do. And you're trading as if it is doing what you want it to do. And finally, as all of the money drains out of your account, you realize that the market did not share your dream. The market did not know you existed. The market just did what the market does. And you were insisting that it do something else. And so, if you keep expecting the same exact thing out of the market is virtually always going to disappoint you. Every once in a while, it'll do exactly what you're expecting it to do, but you're probably not going to you're not going to stick around as a trader too long with that attitude. So it's really, really important, guys, to be just observant and as unbiased as possible, and have certain parameters or time frames that you work within, so that when the market starts going, between 9:30 and 4 Eastern, when the market starts going, you have your parameters, you have your routine, you have your things that you're doing, and you're not going to be making a bunch of random trades. So anyway, that's what I think anyway.
Fully agree with what you're saying, especially when the market is pulling back. You can kind of flip back into that mindset of, oh, I want to make money again because I just did, and that felt good, and I want that feeling again.
Right.
And that's where you can get in your own way in trading. And really, in this environment, when we are pulling back, you want to look for that strength. You don't want to buy the pullback. You want to buy the bounce after the pullback. And so that's what I'm looking for on some of these stocks that have been performing really well, because the idea is if they performed really well over the last little while, then they should continue to perform well. And so we want to look for that strength to come back into some of these stocks that had been leading before, like NVIDIA, like Meta, like Apple, Amazon, all of these true market leaders.
Yeah, no, that's well said, Scott. What I'm doing here is I'm going on what Scott was just mentioning. So we see that this is the trend of a stock. If somebody's just listening to this as opposed to watching it, I'm just drawing an upsloping line of peaks and valleys like you see on uptrending charts. So this is the thing. If we look at this stock, the way I see it, there are just very, very few times to be buying this stock. Like, I don't know what happened. I don't care what happened back there. It's an imaginary chart anyway. The times to be buying, at least the way I look at it, is you want to buy here. Like if you see, oh, this is an uptrending stock and then it's pulled back, you're not buying here. You're not buying here. Oh, wouldn't that be nice if you were every time? But you're buying like at the first sign of strength, and then you're putting a stop like right there. Okay. And then the next time to buy, and in this market, this is, in my view, kind of a lower probability buy, is when the stock pushes above this last high here. Okay. Now, this chart's getting really messy, but what I'm really talking about is this. You're buying here and you're buying here. And again, this is the better one in my mind right now. Now, there will come a time when you don't get these pullback rebound opportunities to buy much, because the market's so strong that the only thing you can be doing is buying a breakout and then just ride the lightning, just let her run. Use the old Metallica album cover there. But anyway, but right now, this tends to be the better one, is buying in an uptrending stock, a pullback, and don't buy the pullback. By the recoil, the rebound off the pullback. So, and the reason you're doing that is because if you're waiting for some bounce, just think this through. It only takes a couple steps. Why am I buying right here, right now? I'm buying right here, right now, because I see this rebound, and that's telling me that the aggression of sellers is now being outweighed by the aggression of buyers, which means I don't think the stock's going any lower than it just was, and now it's coming off of that low. So I think that's the low. So I'm going to go ahead and buy this right now. Okay, here's your advantage in doing that. Your advantage in doing that is exactly what has to happen for you to be wrong, because you know exactly why you bought the stock. You bought the stock because you believed, based on what you were seeing and what your experience was, not your magical thinking. You bought the stock because you believed that right here was the low of the stock. You would be wrong if the stock goes even a little bit below that level. So you're buying the stock here and you have a very, very, very tight stop right there. And so this is why these pullback buys in uptrending stocks are really a good strategy. Now, what about buying here or here or here? Okay, that's all well and good too. According to this hypothetical chart, look, we're all thousandaires here, made $1 bazillion here, bought anywhere here. But if you're buying at any of these other areas, and I'm just kind of using the same drawing tool, sorry, but okay, this is your support right here. So if you're buying up here, the stock has to fall farther before you're wrong. If you're buying up here, it has to fall even farther. So, this is intuitively obvious to anybody who's been trading for any period of time at all. And that is, the closer that you buy to what I call your drop dead level or the oh crap level or oops, I'm wrong level, whatever it is, the closer you buy, the less risk you are taking. Now, you can buy any stock at any time and have a super, super low risk. And because you can control where you put your stop. You can buy a stock that's gone up, 98% in 15 minutes and have that be a really low risk trade if you put your stop 2% below where you bought it. So, but who would do that? Nobody that I know. So what we're talking about though is the risk that you're taking in a trade versus the probability of that trade working out. So we're trying to do the best of both worlds here. Okay, we're trying to buy at a really good point here, close to our level of what we would call like a pivot point. Like, okay, this is the pivot from selling pressure to buying pressure. I'm in very close to support. I have a very, very low risk trade, but it's a high probability trade. Why? Because the stock is trending higher. So it's kind of like we're in the right neighborhood. Now we're just looking for the right entry. Okay. So anyway,
And I think, Dan, as well, it's really important to talk about time frame. So if you're buying close to support, like you're talking about, that can work for either a long-term trend entry, like I want to hold this stock for the next 3 to 5 years, or to kind of jump on the trend, where if you want to buy a little higher, like buying a new high, then that's a breakout buy. And so your strategy for each of those entries, and you really always, hammer on the importance of a good entry. Your strategy for those entries has to match your time frame for when you want to hold the stock. Because if you're buying a breakout, that's different than buying a long-term pullback entry in a trend. And so, your risk tolerance has to be different for each entry.
Yeah, it really does. And the point that you made about time frame is really important, Scott. I think about that a lot. One of the challenges of sitting in this seat and Scott, you have the same challenge is, you're talking to people that have distinctly different time frames. We have people that are essentially day traders and others that are short-term swing traders or whatever, and then others that have much longer time periods. And so it's really the kind of thing where you're always switching time frames. Like I've got this here. It's what was I looking at last? 1 minute, 5, 15 minutes daily chart just to keep my frame of reference and stuff. But and this is just one example of time frames. But you can be looking at the daily, the weekly, monthly, and they're all different. And I think that, frankly, once you've been trading for a while and you kind of know what your time, what your style of trading is, what your time frame is. Once you know that, don't change the time frames on your chart. Like there's so many times when like I might be looking at a chart like, oh, Microsoft, looks pretty good. Fell below the 21. I got to watch that. Maybe it's a blah, blah, blah. And then I'm kind of moving on to different things. And then, then I come back and I happen to look at this and it looks different. And the reason it looks different is because I didn't notice it, but I'm on the weekly chart as opposed to the daily chart. So I would look at this like in an entirely different way. Something like this as well. This is a weekly chart. No, thanks. I don't want anything to do with that. And then on the daily chart, still no, thanks. I don't want anything to do with that. But hey, maybe I'll watch this for a bounce because I see this trading range here. My point is that you want to, and here the same thing. This is, you see what's happening here. Like this is a real interesting chart here. I'm switching time frames. This looks very different. And it's the same stock, just in different time frames. And frankly, you're going to get really confused if you're looking at a stock in all these different time frames. It's fine to say, well, I use the weekly chart for trend and the daily chart for entries. Fine. Great. Me too. But if you're looking at all these different time frames and all these different stocks, and the whole idea is you're trying to find a trade or something like that, if you keep searching long enough, you're going to find something, but it's probably not going to be the right thing. So you want to be trying to get your time frames as tight as possible. I've mentioned this before, but I don't assume that everybody hears everything I say, and Lord knows, I hope not. And that is that Dave Ryan was talking about, the late Bill O'Neill, and he said, and O'Neill was an amazing trader. He said he never saw O'Neill look at a daily chart, always looked at weeklies. And I want to get to the stocks that you guys have been asking about. But the point on that is I want to go back to something that Scott had mentioned as far as entries. You can look at a weekly chart on all of your stock trades, but if you don't have a good entry, the whole trade, you're dealing with it from a position of weakness, because when the stock's going to give you this ebb and flow. Everything, moves up and down. Everything moves up and down. But if you didn't get in during the first part of the up, then when the stock starts pulling back, trading sideways, drifting lower, you don't have a cushion that gives you the comfort of saying, okay, well, I got a longer time frame. I like the way this is trading. Oh, it's pulling back a little bit. Good. It needs a rest. Yeah, let's see this profit taking. Be nice to see people kind of clearing out a little bit, make room for another big run higher. You can have that kind of attitude in a trade as long as you're in at the right time, but at the right point, a lower risk, higher probability entry. But if you're just buying a stock, then and willy-nilly, like, oh, I see this stock, I think it's a good buy, I'll buy it right here. Well, then you're not in the trade really, you're just in a stock. And then when the stock starts pulling back, the first guy that bought it right is totally comfortable. It's going like, well, the stock's working for me. I'm not going to, if I'm just selling it every time I see it being higher, I'm going to be a day trader. You bought it high, and now you see the stock pulling back a little bit, and now you're concerned. You don't see it through the same lens as the other guy does. So the lens that you look through to see a stock is absolutely colored by the entry that you took in that trade. You will see things entirely differently if you just make sure that you get a good entry. And this is the other thing. There are not that many good entries on any stock on any chart. There just aren't. And that's actually a good thing. It can be frustrating if you're looking to get in on a stock, or you're going, I got money to burn, I need something to buy. Okay, that can be frustrating if you're trying to trade well, but you're really, really looking for a trade. But thank God it's that way, because if there were good entries every day, the stock would never go anywhere. The whole reason why we look for good entries is because we make money on the in-betweens. We make money on the time and the move between when we bought and when we sold. And that means that after you buy, you need to just step back and let a stock do what the stock's going to do. And it will do what it's doing based on activities of traders that weren't as good as you were in when you bought the stock. You let others chase the stock so you don't have to. You already got it. And so you sit there and you hold. Somebody else who's going like, oh, I got to buy this stock, and you're going like, yeah, I'm glad I did last week. You go on ahead. Institutions are the same way. They will keep buying a stock and keep buying it and keep buying it because they got to get a lot of shares in the books. And you've already bought it and you're just sitting there. The point is, you made a good entry. Let the entry reward you. And the entry will reward you by sitting on your hands after you've made that one good entry.
And one final note there on Timeframe, Dan, what I think you said, a possible action step for everyone here on the webinar is to know what you are supposed to do on each time frame. And so if you're looking at a daily chart and you want to enter stocks on a daily chart, then you write down the daily chart is where I buy. And if you are looking for trend, okay, what time frame do I look at the trend on? Okay, this is it. And then really make that, what I like to call an irrevocable committed decision to sticking to that system, because that will help you, stay clear when the market's going up and down and all over. You are focused on your system and being like, no, it doesn't matter. I don't care if this is doing that because I enter on the daily chart and I don't have my signal yet. So anyways, just wanted to bring that up because I thought you're making some good points about, what each time frame is and the purpose behind each time frame.
No, that's Scott. Everybody, I hope you got what Scott was just saying. I hope that I didn't bore you with all of my, monologue with my, crappy voice and, sound more dead than alive. But what Scott said is super, super important if you want to be a successful trader. And that is, you write down write down your process. And I'm not talking about a big, long, thing. I mean, you should have that, but yeah, if you're buying a stock based on the daily chart, write the frickin' thing down. I only take action based on the daily chart, or whatever the case may be. And then after I buy the stock and set my stop, I never look at the daily chart. I only look at the weekly chart and only make my decisions for selling or for buying, whatever, based on the weekly chart. Whatever it is, have something written down in order to keep you on track. Because I was doing some writing over the weekend, and this is kind of one of the things this is why I seized on what Scott had just mentioned, because I was thinking about this, like there are so many things going on. How do you stay organized? How do you, that's organization's always been a challenge for me, because I'm an idea guy. Think about 98 bazillion things in one time. And, it's always a big stew in my brain. So it's really hard for me to stay organized. And that makes, and trading is very, very challenging that way for me. But the way that you cut through all that clutter is to write stuff down and have a little, have a little log or some kind of thing, a bullet point thing. Yeah, you don't have my video, but I have my notebook here that I'm rattling the pages that sits right beside me that I write stuff on every day. And I have a little checklist for things, we'll call it a recipe for buying, a recipe for selling. And then you want to always look at that until, as you're doing something. And what you will find is over time, you will not have to look at it anymore because it's just ingrained. But if what I'm saying to you, if what I'm saying is resonating with you right now, then you're not there yet. If what I'm saying, and you're listening to it going, yeah. No, that's a good idea, Dan. I don't need that. I have my specific thing that I do. Well, then that's great. You're there. But if you feel like you've been, you're trading inconsistently, or always kind of looking at yourself in the mirror going, why the hell did I just do that? What was I thinking? If I'm describing you, then what Scott just mentioned in what I'm telling you now, this is your golden ticket. And that is when the market is not open, take some time and write down your recipe for trading, exactly how you do it. I'm not going to talk about it right now, but I'm just saying this is something that you have to do. And once you do that, here's the thing. You can always do it in pencil and then change the recipe as you go through your trading days, your weeks, your months, your years. But you got to have something to start with. And what you're going to find is over time, that trading recipe, that series of steps or bullet points is going to become yours. Somebody else would not work for somebody else, but it works for you because of your specific individual and unique mindset, emotional mindset, your financial needs, your time, et cetera, et cetera. It works for you. And you keep following that and you have to keep following it. And you have to keep following it until at some point you don't need to keep following it anymore because you're just doing it. Because that's just like what you do. And that's the difference between the third and the fourth stage of competency. It's how we learn. The first stage is you don't even know what you don't know. By the way, we see this all the time, not just in trading, but in culture. You see these dumb idiots running around thinking that they know every damn thing. And the bottom line is some of us old farts look at them and go, you people don't even know what you don't know. Isn't it nice to be you because you think you know everything? Okay, that's the first stage. I would call that complete stupidity. But anyway, the second stage is a little more humbling because you start learning what you don't know. Okay, that's where your learning starts. When you learn what you don't know, you go, okay, well, I got to start learning some stuff. Okay, then you got to bridge the gap between there and the third stage, which is, yes, I have learned a lot. I am now a competent trader. I know what I need to do. I have that little recipe or that checklist that Scott's talking about, that Dan's talking about, and I follow it pretty well. I goof up every once in a while, but that's me. That's trading, but I'm doing really well. I know what I know, and I do what I know I'm supposed to do because I have my checklist here and I follow it. And then finally, the last stage of competency, that's the fourth stage, is you don't even remember what you know, you just do it. It's called unconscious competency. You don't have to think about it anymore. You just do it, and you can't imagine doing it any other way. That's ultimately where you want to be as a trader, but you don't just get to be there by deciding you are there. You have to go through the process, and it can be as long a process or as short a process as you want. It just depends on how hard and consistently you choose to work for it. So anyway,
Solid stuff, Dan. No, that's real good. We could, honestly, we could do a whole weekend webinar on this. And a lot of what you've talked about is in your next step premium kind of thing that is like 3 days long.
Yeah.
And so, I know it's hard for you not to just pour it all out right now.
I know. Anyway.
All good, brother.
All right, man. Hey, Scott, thanks for your help, buddy. I really appreciate it, as always.
All right. We'll talk to you soon.
All right. See you guys next time.
Thanks for listening to the Fitz Factor podcast. For more from Dan Fitzpatrick, check out his premium service at stockmarketmentor.com.